Okay, let's unpack this. Welcome back to Deep Dive. Today, we're cutting straight through some of the national headlines and really diving into four critical areas of financial news. All of our research today comes from the Seoul Economic Daily. Our mission is pretty swift, pretty clear. We're looking at a regional banking powerhouse that's sort of rewriting the rules. Then we'll get into some major national policy shifts, things aimed at funding future growth and, fixing that ticking time bomb of an aging society. And finally, a big risk indicator that's flashing red in the digital asset space. So let's start with regional finance. It doesn't usually grab the big international headlines, but BNK Financial Group is doing something fascinating. They're aggressively embracing what you might call productive finance. And the numbers in their loan portfolio are just staggering compared to the big city banks.
They're really remarkable, a huge distinction. I mean, if you look at BNK's affiliated banks, you've got Busan Bank and Gam Bank.
Right.
Their corporate loan ratio is at 65.7%. Now, you have to understand, that's over 14 percentage points higher than the average for the typical city banks. They're hovering around, 51.2%?
So that 14-point gap, that's not just a number, is it? It feels like a fundamental philosophical difference.
It is.
Citibanks seem to favor the easier, the higher volume consumer and household debt.
Exactly. Whereas BNK is just doubling down on supporting actual businesses.
And what kind of businesses are we talking about?
Well, within that corporate focus, their dedication to small and medium-sized enterprises, SMEs, it's unwavering. BNK's share of SME loans has stayed consistently near 90% for years. The last measure was 89.2%.
That is a huge concentration.
It is, and you can contrast that with the city banks where that SME loan ratio has actually been dropping. It's down to 80% this year. So BNK is really staking its entire existence on being the engine for these regional SMEs.
It sounds less like standard banking and more like a deliberate strategy for regional economic health, almost like that idea of stakeholder capitalism.
That's a great way to put it.
Proving that if you prioritize the local community, that can also drive profitability.
And that perspective is precisely what their chairman, Bin Dae-in, has been championing. He's explicitly said the goal is to leverage regional strengths to build a differentiated success model for productive finance.
So he's justifying their whole role in the market.
That's the idea.
Okay, so how are they turning this philosophy into action? I mean, it can't just be about issuing loans. You can't just lend money and hope for the best, especially in what can be sluggish regional economies.
Oh, no, you can't. And they've created a formal structure for it. They just launched the very first Productive Finance Council among all the regional financial holding companies.
Oh, council, okay.
And they're putting some serious capital behind it. We're talking about a planned investment of 20 trillion Korean won.
20 trillion, that is a massive commitment.
It's huge. And it's earmarked for regional specialized industries, so things like shipbuilding and marine, but also the cutting-edge sectors.
Like what?
AI, aerospace, secondary batteries, the future stuff.
That sounds like a really smart diversification. You're balancing the existing regional strengths with these future growth drivers.
Right.
But when you're prioritizing regional impact, how do you measure success?
Right.
It can't just be standard financial returns. That's always the sticking point with these kinds of initiatives.
And that is where they've really innovated their review process. BNK is actually adopting an investment productivity index.
An investment productivity index, what does that mean?
Well, it's a metric they use in their lending and investment review process. And this index doesn't just look at the immediate profit margins.
Okay.
It specifically prioritizes projects that have a high local economic ripple effect. So it ensures that the capital injection maximizes regional employment, economic stability, even if those financial returns take a little bit longer to show up.
That's a key takeaway for you right there. A bank actively integrating social impact metrics right into its core lending algorithm. It's a pretty brave move. But you used the word sluggish earlier. When a bank has such a high concentration in regional SMEs, doesn't that inherently increase its risk profile compared to a nationally diversified city bank?
Yeah.
How do they manage that concentration risk?
That is the constant challenge. It absolutely is. And it's why their financial results get scrutinized so closely.
What are they doing?
Surprisingly well, they've managed to deliver. BNK recorded a cumulative net profit of 770 billion KRW up to the third quarter of 2023.
So a record year is likely.
Very likely. And on top of that, their capital soundness has improved significantly.
How so?
You can look at their CET1 ratio. That's the Common Equity Tier 1 ratio. It's basically the key metric for a bank's ability to withstand major financial shock.
And that number is going up.
It improved dramatically from 11.15% at the end of 2022 to 12.59% by Q3 2023. A rising CET1 means they have a much thicker capital cushion to absorb any unexpected losses.
Which is absolutely essential. I mean, given the persistent concerns over real estate project financing or PF default risks, especially in those regional markets where economic stagnation is a constant threat.
Precisely.
So the strategy is paying off, but that tight focus means they absolutely need that strong capital base.
Exactly. They're mitigating the risk through capital strength and very strategic investment, which, well, it's led to a lot of investor confidence. Their stock price has more than doubled since the end of 2022.
That's incredible.
But, as you said, the PF risk is still a structural challenge, and they also have to improve the operational inefficiencies that come from running a two-bank system.
Yeah.
You know, Busan Bank and Gyeongnam Bank under one holding company.
Right. Successful transformation needs that operational streamlining too. Okay, so B&K is tackling productive finance on a regional level. Let's shift now to the national stage and see how the government's trying to implement this concept across the entire financial system.
This is where the Financial Services Commission, the FSC, comes into the picture. They've initiated some research that's focused on what they're calling organizational innovation.
Okay, innovation to do what?
To better execute the government's core economic blueprint.
And what are the main pillars of that blueprint?
They call them the three great financial transformations. The first is productive finance, which is what B&K is modeling.
Right.
The second is consumer-centric finance. And the third is trust finance, which is essentially about ensuring market integrity.
So the FSC recognizes that their current structure, maybe even their current laws, might not be efficient enough to push these ambitious reforms through.
That's it, exactly. So they're planning a complete overhaul of their relevant laws, systems, personnel operations, everything. And they're targeting April of next year.
They're building the infrastructure for a different kind of future. And speaking of building for the future, that leads us right to the next huge policy focus, dealing with the super-age society. I mean, the demographic clock is ticking very, very loudly, and the need for dedicated elderly care housing is becoming an emergency.
It is absolutely an emergency. There's data from the Korea Institute for Health and Social Affairs. It projects that the demand for nursing facility users will increase by over 60% by 2030.
Over 60%.
Yeah. And if we don't dramatically boost the supply of these facilities, the care gap could leave an estimated 148,000 seniors without the support they need. And that's within the next 6 or 7 years.
Wow, 148,000 people. That is a catastrophic social and financial failure just looming on the horizon. So if the demand is that urgent, why has the supply been so sluggish? What's the bottleneck? What was the problem in the regulations?
The bottleneck was ownership. Simple as that. Under the existing law, any operator who wanted to run a large facility, so that's defined as 30 or more people, they were required to own both the land and the building outright. In a market where real estate prices are just escalating, that ownership requirement created this astronomical barrier to entry. It priced out so many potential investors and providers.
So it basically blocked large-scale institutional investors from even getting into the market because of the massive upfront capital needed for the land.
Precisely. Which brings us to the crucial policy change being pushed right now. There is a proposed special law, and it has support from both the ruling and opposition parties.
That's rare.
It is. And it focuses on one key piece of regulatory relief, allowing the leasing of land and buildings for elderly care housing.
That completely changes the unit economics, doesn't it?
It's a total game changer.
It shifts that massive capital requirement from this huge upfront purchase to just manageable long-term operating costs.
It really is, especially for the insurance sector. You have major life insurance companies, Samsung Life, KB Life, Shinhan Life. They have all identified elderly care as a crucial future growth engine.
Because their traditional market is saturated.
Exactly. Their domestic market is saturated. So the removal of this ownership hurdle is highly, highly anticipated by them. It just unlocks their ability to deploy their significant capital into this sector that needs it so badly.
That's a brilliant connection. So you see how a national policy, which is driven by demographic necessity, provides a new lifeline for a stagnant industry insurance while also addressing a critical social crisis. It's a rare win-win.
Yeah.
Okay, now let's pivot sharply from physical assets and demographic pressures to the volatility in the digital financial market. We have to talk about stablecoins.
Yes.
They've seen a massive and frankly concerning exodus of capital recently.
We have. The total market capitalization of stablecoins globally dropped by $2 billion. That's roughly 3 trillion KRW.
In how long?
In just 1 week.
1 week. Now that sounds like a big number, but give us some context. Why is a $2 billion drop significant enough for us to be talking about it?
It's about when it happened. According to the blockchain data platforms, this is the first weekly decline in the stablecoin market cap since the immediate aftermath of the Terra Luna crisis back in mid-2022.
Wow. So that signals a deep underlying instability might be returning to the market.
That's the fear.
And this drop is linked to these repeated incidents of depegging this month, right? Where stablecoins briefly lost their one-to-one value with the dollar.
Correct. We've seen a series of these depegging events with some of the smaller dollar-linked stablecoins like XUSD and USDX. But what's more concerning is that during recent periods of high liquidation, even major players like Tether, USDT, and USDD showed brief signs of instability on certain exchanges.
So in the foundations of stability, the stablecoin itself starts showing cracks. The whole market gets nervous.
It does. If stability isn't stable, the whole value proposition just vanishes.
So you have these internal cracks, but there's also an external factor playing a role here. The sharp drop in major virtual currencies like Bitcoin.
Absolutely. The correlation is crystal clear. As Bitcoin dropped sharply, it fell below the $90,000 mark, the demand for stablecoins naturally went down. Stablecoins, despite their name, they primarily serve as a transaction vehicle or maybe a temporary safe haven within the crypto ecosystem.
Okay.
When the market is in a sharp decline, trading activity plummets, and you just need less capital to facilitate those transactions.
That's a fascinating inversion. We usually think of Bitcoin driving everything, but here, the lack of interest in buying Bitcoin reduces the need for the intermediary currency, the stablecoin.
And this is the critical implication for you, for anyone listening. Industry experts widely regard the supply of stablecoins as a leading indicator. Some call it the fuel for the entire crypto market.
The fuel for the market.
Right. And when that fuel gauge drops this rapidly, as this $2 billion outflow suggests, it's a strong signal that potential future market volatility is on the horizon. There's just less accessible capital ready to jump back into risky assets when the time comes.
Less fuel means a slower car, or maybe a much bumpier ride ahead. This interconnectedness is just incredible. From local banks funding small businesses to national policy fixing social crises, and then all the way to these volatile global digital markets. It shows you just how complex the modern financial environment really is. So, until now, we have covered the role of regional finance, policy changes, and risks in the digital financial market. We'll return next time with Rapid News. This has been the Deep Dive from the Seoul Economic Daily. Thank you.